What is Grab? At a high level, Grab offers three main services: delivery, mobility, and financial services. Deliveries can be broken down into delivery services for food, groceries, and packages. They also operate grocery chains Jaya Grocer and Everrise in Malaysia. They also offer mobility in the sense that they offer ride-hailing services, including private cars, taxis, and motorcycles. They also just launched GrabCab in Singapore, becoming the sixth taxi operator in the country. As for financial services, they offer a payment platform, GrabPay, be it buy now and pay later, insurance, Grab Insure, and rewards, Grab Rewards. Independent of all these apps, Grab also operates three digital banks, namely GXS Bank in Singapore, GX Bank in Malaysia, and the Super Bank in Indonesia. Some people call it the Uber of Southeast Asia, but it's a lot more than that. Grab is by far the largest super app in Southeast Asia, providing delivery, mobility, and financial services to millions of consumers, merchants, and drivers across 800 plus cities in 8 countries. Grab is well positioned to benefit from autonomous vehicle adoption in Singapore. Grab successfully launched Mandarin as a language option. There were a record number of Chinese tourists, about 1.4 million, visiting Malaysia between January and April of 2025. Grab's launch was crucial to test the sustainability and demand among tourists with language barriers as they work towards introducing support for other additional languages. They plan to offer multiple languages based to all tourists in 8 countries it operates. In my opinion, they're well positioned to capture tourism market share from luxury regular rides, food delivery, travel package, Grab Pay, insurance, to dine out discount options. As you can see on the image on the left, the stock is down 60% from its peak, despite being a much larger and more profitable company than ever before, with a record number of monthly transactional users, a more diverse product line, and a hyper-growth fintech unit. Here's Grab's summarized income statement. Revenue increased for the 5 years straight from 2020 to LTM 2025. You can see it grew 43.9% in 21, 112% in 22, 65% in 23, and 19% in 24, and is already showing almost a 10% gain in the LTM here. Gross profit has also increased every year for 5 years straight from 2020 to 2025 on a nominal basis and from a margin basis. Just look into the graph here, you can see, the growth in margin has been 111%, 1,700%, 37%, given it's been negative, so you can disclude the 1,000% here, but as an actual margin percentage, you could see the expansion from 3.2% to 34.7 to 40, with the LTM even incrementally hopping up there to 41%. Here's a summary of the assets on the balance sheet of Grab over the last 5 years. First, I like to start by looking at enterprise value. So the market cap I pulled beforehand is 20.9 billion. They have 7.3 billion in cash and short-term investments. Debt is 1.8 billion and EV would be 26.4 billion. If you look at the cash on the balance sheet, it represents almost 25% of the total value of the company, trading at a 1.3 times tangible book value. I think it's particularly important to look at the company now because looking at their cash flow statement over the past 5 years, the LTM is yielding the first profitable net income period yet. An even more important measure, free cash flow, turned positive in 2023 and has remained positive for Grab since. So here's the back of the napkin, DCF. You can see I grew revenue in 25 and 26 by the analyst consensus of like 22 and 19%. And then I held it steady at 20% until 2032, held it steady at 10% until 2035, held steady at 6% until 2040, and the terminal at 3%. The free cash flow in 24 was 25%, but it's actually expected in guidance to go downward more towards 17 to 18% in 25 and 2026. So then from there on, I gradually grew it from 20 to 22% and held that steady through the terminal, which in my opinion is a bit conservative. Mid-year convention, if you don't know, you can Google mid-year convention and discount rates, but it's 1 divided by 1 plus the discount rate raised to point 0.5, and each period would be plus 1. So the next period isn't point 0.5, it's 1.5, and then 2.5, 3.5, 4.5, so on. So the sum of the present value of all those cash flows was 44 billion, and we had 1.9 billion in debt, which you would add on, but we had 7 billion in cash, so we subtracted that out for an enterprise value, but you would need to pay to acquire the company of $39 billion. There's 4 million shares, implying a price of $9.60 from today's price of $5.13, or a upside or margin of safety of 87% conservatively.